Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals, in our 26th year in business. It's midday, Thursday, May 28th, 2015, and the title of this week's audio blog is Upcoming Week of Infamy? Well, I have lots to cover today, particularly as we head into what may one day be remembered as a week of infamy. And even if economic Mother Nature doesn't yet overrun the historic manipulation of free markets that futilely seeks to usurp her, the odds of said day of reckoning coming will likely have grown significantly larger. The fact is, essentially everything the powers that be have attempted, aside of course from the market manipulation that must eventually fail, has had the so-called anti-Midas effect in proverbially turning gold to lead. With each passing day, the unprecedented global fiat Ponzi scheme edges closer to the cliff it must inevitably plunge over. And when it does, be it next week, next year, or soon thereafter, if you haven't yet protected your assets, it may be forever too late. That said, I feel compelled to start with a topic I know a thing or two about. I mean, after 13 years of not just observing firsthand, but thoroughly researching precious metals manipulation, I guess I have a better handle on it than 99.9% of those in our sector and 99.99999% of the global population. In fact, I got my blogging start as far back as 2004 on the GATA website, where I diligently wrote nearly every day, again for free, for the same reason I do so today, which is to empower readers to feel confident in their views of the economy and financial markets, no matter how unpopular they may be. Of course, unpopularity was a significantly different concept back then, as in the mid to late 2000s, even with gold and silver prices rising every year, the majority of people had successful investments in stock and real estate to use as reasons to denigrate people like me. Today, even with the Dow Jones propaganda average and other completely rigged markets at or near record highs, no one says a word to me, as care of two market crashes and a relentlessly weakening real economy over the past 15 years, few of the 99% have material investment gains to speak of, and thus could care less about precious metals, not even enough to kick them when they're down. Anyhow, amidst an incomprehensible torrent of precious metal bullish news last week, such as Thursday's rare 7 for 7 economic data misses, and oh yeah, the announcement that China is launching a $16 billion fund to purchase physical gold for sovereign governments, precious metals were viciously attacked on Tuesday morning just as the Memorial Day weekend concluded. Immediately thereafter, an article surfaced from someone I have a great deal of respect for in our sector, which unfortunately my 13 years of experience on the topic have taught me to ignore completely, which is that, according to the article's title, something big is about to happen in silver. The premise is that last week, the so-called COMEX commercials, i.e. JP Morgan and Friends, dramatically increased their short positions in silver, and for that matter gold, and thus a new major smash is possible. In fact, such articles anger me to no end, as in effect they serve to create self-fulfilling prophecies by scaring already battle-worn precious metal owners to the point of apoplexy. In other words, telling investors to assume the cartel will keep winning just because they have in recent past. In other words, breaking the cardinal investment rule that past is not prologue. And this from a guy who knows very well that the cartel is there. Remember, we own gold and silver, physical gold and silver, not paper proxies like ETFs, mining shares, and futures, to protect us from the monetary Armageddon we know is coming, and not to trade in and out in the hope of minor short-term profits. Of course, I have no crystal ball as to what tomorrow will bring. However, I cannot disagree more with the assumption that major commercial shorts have any particular meaning, as such theories are not based on facts but spurious correlations. To wit, all the way back in February 2012, more than 3 years ago, I wrote an article titled "The COTs Don't Matter," which you can Google by typing "The COTs Don't Matter, Miles Franklin." In it, I discussed how, for most of the 2000s decade, COT commercial positions nearly guaranteed what was coming. That is, whenever the commercials meaningfully increased their shorts, which invariably occurred to slow down gold and silver rallies, you could take it to the bank that a major smash was coming. Conversely, when major commercial short covering occurred, it was equally guaranteed that a rally was coming, as back then, relentless cartel smashes notwithstanding, the PM bulls had the upper hand, forcing the cartel to allow the surging market to exhale when their illegal machinations had forced prices down too far. That said, after the global economy and financial system permanently broke in 2008, this relationship between COMEX commercial short positions and subsequent gold and silver price moves broke as well. Let alone after the late 2011 central bank point of no return, when they realized their post-2008 money printing orgy was decidedly failing to save the dying global economy and markets. At which point they unleashed an unprecedented bazooka of money printing, market manipulation, and propaganda, including Abenomics, QE3, and now the ECB's crazy QE program, which has since taken global stock markets to record levels and precious metal prices to multi-year lows, whilst the global economy has plunged to its singularly weakest point in generations, with far lower depths coming. Anyhow, since roughly 2011, there has been next to zero correlation between commercial positioning and subsequent gold and silver price movements. Although the one thing that clearly hasn't changed is the fact that the cartel continues to always increase shorts into rallies and always cover them into smashes, or declines. Moreover, the group of banks, jewelers and miners, that supposedly are the global experts on precious metal prices, have been net short since prices bottomed in 1999, with not a single bullish week among them. No, there couldn't possibly be anything fishy about that. Anyhow, said article cites last week's 24,000 contract silver commercial short increase as evidence of an upcoming silver smash, when in fact, not only is the overall level of silver commercial shorts smack dab in the middle of its 15-year range, but 24,000 contracts is nothing in the big picture of things. To wit, we have seen many significant short buildups in recent years that have amounted to little or no net impact on prices. And even when prices did materially move, they invariably recover their losses or gains immediately thereafter. Which, by the way, is what angers me so much about such articles. Anyhow, just look at the 5-week period from June 10th to July 28th, 2014. That is a year ago, when the COMEX commercials increased their silver short position by a whopping 48,000 contracts, or twice the amount reported last week. Did the silver price get smashed while this was occurring? Nope. It actually rose from $19.20 an ounce to $21 an ounce. Or how about the 12 weeks between November 11, 2014 and January 27, 2015? I mean, we're talking a few months ago, when an equally ominous 52,000 silver contracts were shorted by the so-called commercials. And that time around, you ask? Well, silver rose again, this time from $15.70 an ounce to $18.05 an ounce. No, my friends, the commercials no longer use the fraudulent COMEX data to signal their intentions, particularly as since 2 years ago, the CME has addended them with a disclaimer that they cannot guarantee such information is in fact true. Yes, they still unduly attack the Huey Mining Index to signal their minions of impending paper smashes. However, as for the COMEX data itself, I now follow it simply due to curiosity, as like precious metal technical analysis, it currently holds absolutely zero meaning in a 100% 24/7 rigged market. That said, if you want to know what the most likely reason for Tuesday's paper raids were, other than that gold and silver had the gall to cross the cartel's maniacal lines in the sand at $1,200 per ounce gold and $17 per ounce silver, respectively, look no further than this week's COMEX options expiration, starting with Tuesday's, as in 3 days ago's, or 2 days ago's contract termination, and tomorrow's, i.e. Friday's, first notice day, i.e. when contract holders notify the exchange of their intent to take delivery of actual physical metal. Which just happens to coincide, by the way, with the first revision of the first quarter GDP, which, because the BEA is not yet applying its new and improved double seasonal adjustments, will likely be significantly negative. To that end, recall Tuesday's article titled Record High PM Demand, but Record Low Sentiment, in which I noted that precious metal sentiment, care of the cartel, had been as low as Miles Franklin can remember. That is, until last week or so, when demand measurably increased. Next, consider that purported COMEX registered gold inventories, i.e. those actually available for purchase, have plunged to an all-time low level of a measly 372,000 ounces, worth a piddling $440 million, which heck, even Greece might be able to conjure together. And finally, realize that as of Friday, as in last Friday, a whopping 122,000 contracts were still open, totaling 12.2 million ounces of gold, or paper gold. In other words, 33 times more gold claims than are actually available to deliver. And thus, voila, a magic precious metals raid Tuesday morning, enabling all those $1,200 gold and $17 silver calls to expire worthless, as usual, followed by relentless capping since to make sure the impetus to take delivery is minimized. In other words, what we have experienced on this essentially entirely paper exchange for the past 15 years, which thankfully appears destined to be usurped in the not too distant future by the increasingly powerful physical-only Shanghai Exchange, which, by the way, now dwarfs the COMEX in terms of actual physical metal delivered. And by the way, for those still terrified of an imminent precious metals plunge, keep in mind that these very same factors have been around since gold and silver were initially smashed to around these levels nearly 2 years ago. And yet, despite the fact that since the historic April 2013 paper raids, which I deemed the alternative currency's destruction, and unrelenting anti-gold propaganda, prices continue to hang in there, creating a so-called floor level that strengthens with each passing day. Meanwhile, the effect of pushing prices, especially silver, so far below the cost of not only marginal production, but long-term industry sustainability, has been to completely destroy an already dying exploration industry and make it abundantly clear the industry-wide production has nowhere to go but down, particularly in gold in the short term and likely shortly thereafter in silver, which in the aforementioned environment of record global demand, albeit currently focused nearly exclusively in the East, all but guarantees continuing supply deficits as far as the eye can see, until of course the next crisis commences, particularly if it is the big one we anticipate, at which point supply will disappear entirely, just as it did in 2008. And on to the next topic, which I'm not going to spend a great deal of time on because I've covered it so thoroughly in articles like yesterday's The Melody Zhang of Wall Street and last month's All Out Bubble Mania. That said, it's difficult to write this week's audioblog without mentioning just how advanced and unprecedented the global equity bubble has become. And by unprecedented, I mean that unlike, say, 1929 and 1999 stocks and 2007 real estate, they have not been catalyzed simply by easy monetary policy. As this time around, we not only have unprecedentedly easy global monetary policy, but active central bank monetization of stocks themselves. True, the Fed doesn't admit to such, but you'd have to be blind not to see their cartel-like footprints in the stock markets. Not to mention their counterparts in Japan, Switzerland, and Israel, among others, which openly admit to such actions. Consequently, I have largely ignored U.S. stock markets for this very reason, and consequently, they're utterly zero correlation with actual economic activity. In fact, I have for years noted that the odds of the inevitable real losses investors will suffer in equities, not to mention bonds, real estate, and other central bank supported asset classes, are just as likely to occur due to hyperinflation as a 2008-style collapse. Look no further than the Caracas Stock Exchange in Venezuela, like the late 2000 Zimbabwe Exchange and the early 1920s Weimar Germany exchanges before them, which is currently going parabolic whilst the Bolivar currency collapses and reported inflation exceeds 100%. That said, it's becoming difficult to ignore the residual effects of such madness, like millions of Chinese households opening margin accounts to capitalize on a stock exchange that has risen an incredible 150% in the past 10 months, whilst the Chinese economy has imploded into oblivion, with even the government admitting its rigged GDP figures are at their lowest level in 30 years. Coincident, of course, to nearly the week last summer that the PBOC commenced its current Bank of Japan-like explosion of rate cuts, reserve requirement reductions, and as of last week, backdoor QE to hundreds of insolvent Chinese municipalities, if not thousands. Meanwhile, watching the German DAX exchange achieve all-time highs as the euro collapses, the European economy flatlines, and a Greek default approaches like a runaway train, potentially as soon as next week, is simply surrealistic. Whilst here in the States, technology, biotechnology, and heck, fast food restaurant stocks have been fed put goosed well beyond 1999's peak valuations. Not to mention the hideous financial deformations caused by a decade of ZERP, QE, and relentless PPT support, such as the unprecedentedly stupid valuations put on leveraged buyouts and takeovers, such as Time Warner Cable, Broadcom, and Macerich. Need more evidence? Just read David Stockman's expert dissection of these brutal shareholder and nation-destroying deals if you don't believe me. Coincidentally, just as Bank of Japan head Haruhiko Kuroda claimed he doesn't see any asset bubble, stock market bubble, or financial excess in the Japanese economy, Helicopter Ben Bernanke, fresh off receiving his first ever jobs to give insider information to PIMCO and Citadel in the role of advisor, claimed to not only see no large mispricings in U.S. securities or asset prices, but, quote, no risk of a hard landing in China. As discussed in the aforementioned Melody Zhang of Wall Street, by the way, Melody Zhang is a world-renowned bubble artist, Bernanke has become infamous for not only his complete lack of understanding of the very bubbles he helped to create, but has the worst economic track record of any living human, albeit from a role in which he was required, at gunpoint, to be universally optimistic. And by the way, just one day after he made the aforementioned comment about Chinese stability, i.e. yesterday, the Shanghai Stock Exchange plunged by an incredible 6.5% in one day, i.e. today. And of course, the big pink elephant in the room I've been shouting from the rooftops about since publishing September's commodity crash, but don't worry, gold and silver are not commodities. Not to mention October's crashing oil prices portend unspeakable horrors, and the scariest article of all, i.e. January's direst prediction of all, of how decades of monetary deformation have fostered massive oversupply and overproduction across the entire commodity spectrum, yielding the likelihood of massive price pressure in some of the world's most heavily leveraged and overemployed sectors. Anyhow, for those with two eyes and a lack of denial, the rollover of the handful of commodities not relentlessly declining, particularly the high-profile industrial commodities oil and copper, which unquestionably have been recently supported by newly formed oil and copper PPTs, has commenced anew. To wit, the CRB commodity index is now within 4% of its March low, which just happens to coincide with its 2008 spike bottom low, and this with oil 35% above its March low, which should tell you just how weak the average commodity has been. And this before next week's OPEC meeting, which likely will provide a mortal blow to the oil PPT's plans of saving the collapsing global energy industry, which happens to be by far the largest producer of United States capex, jobs, and high-paying jobs. Moreover, the equally lethal dollar explosion I warned of nearly 2 years ago is back with a vengeance, with everything from commodity currencies like the Aussie, Loonie, and Kiwi, to BRICS currencies like the Rial, Ruble, Rupee, and Rand, and of course, the world's second largest currency, the Euro, mere days ahead of a potential Greek default, are free-falling anew. And I haven't even spoken of the yen, which at the outset of Abenomics 2 years ago, I predicted would be the first world currency to hyperinflate, which has decidedly broken multi-month support this week en route to what could be a horrific crash in the coming months. Consequently, gold prices are surging the world round, and thus it's only a matter of time before the aforementioned record gold demand overwhelms the US-based cartel, particularly as the US economy itself is on the verge of all-out collapse, as depicted by this morning's hideous Bloomberg Consumer Comfort Index, which continued its most rapid decline since, yep, you guessed it, 2008, and rising jobless claims, seasonal adjustments notwithstanding. As for Greece, how much more pathetic could the situation become? Just 8 days from the June 5th interest payment of a measly $330 million, which the beleaguered nation admits to not having, let alone the $1.4 billion owed shortly thereafter, none other than Alexis Tsipras himself was called out for literally lying to the market yesterday that a new credit deal was imminent. The US PPT, of course, used the false rumor, as it always does, as if Greece's collapse is the only factor affecting markets, to reverse the prior day's equity losses, despite the fact that mere hours later the rumor was refuted by everyone from the IMF to Germany to JP Morgan itself, which deemed Greek markets uninvestable. Deutsche Bank, which likely has more to lose from a Greek default than any other bank in the world, today raised its Greek default odds to 70%, which, although somewhat less than the 100% odds I gave 2 years ago, is, for a cheerleading Wall Street bank, as bearish as it gets. As for today's audio blog topic, who knows if next week will catalyze the inevitable big one we all know is coming. However, starting with tomorrow's GDP revision, likely to extremely negative territory, followed by the potentially twin death blows next Friday, June 5th, I wouldn't be surprised one bit if all hell breaks loose, relentless global PPT efforts notwithstanding. To start, OPEC's June 5th meeting is widely expected to decidedly not yield production cuts, or for that matter, any hope of such, which is exactly what I've been vehemently claiming for months, based not only on common sense, but my decade-plus experience as an energy analyst. Throw in this morning's announcement of a massive 3.3% surge in U.S. oil production this week, as the U.S. government tax incentives I wrote of months ago start to kick in, as well as Iraq's production hitting a new record high and the first API inventory build in 3 weeks, and the stage is set for reversal of the bogus oil PPT-inspired WTI crude oil bounce that decidedly stalled out at $60 per barrel. And then you have not only what should be another punk NFP report, but the Greek interest payment deadline setting up Friday, June 5th to supply the end of a potentially historic week of infamy. Consequently, the time is now, particularly with prices suppressed well below the cost of production, amidst record global demand and the ominous prospect of peak gold staring us in the face, to protect your assets from what's mathematically certain to be arriving shortly. To that end, for those considering the purchase or storage of precious metals, we hope you'll call Miles Franklin at 800-822-8080 and give us a chance to earn your business. Moreover, we emphatically invite you to listen to the 2 special podcasts we recently taped with President and co-founder Andy Schectman, both of which are available, like everything else, on the Miles Franklin blog website for free, or better yet, by simply Googling the titles. The first, taped last fall, is titled Brink's Montreal Storage Program, and the second, taped last month, is titled Swaps, Trades, and Repatriations, discussing myriad opportunities to optimize your precious metal portfolio. And as always, I can be reached via email at ahoffman@milesfranklin.com. Thanks and have a great weekend.